Hey everyone, welcome back to the channel. Today, we're diving into some big economic news out of China. In February 2025, China's Consumer Price Index, or CPI, dropped by 0.7% compared to last year. That might not sound like much, but it's actually the first decline in 13 months. And it's raising red flags about deflation creeping into the world's second-largest economy. Let's start with the basics. The CPI measures how much prices for everyday goods, like food, clothes, and appliances, are changing. A 0.7% drop means prices are actually falling, which might sound great if you're shopping, but it's a warning sign for economists. Why did this happen? Well, two big factors stand out. First, the Lunar New Year came earlier than usual in 2025, shaking up seasonal demand. Normally, people stock up before the holiday, but this time, the timing threw things off. Second, vegetable prices crashed by a whopping 12.6%. Why? Better supplies after the holiday flooded the market, driving prices down. But here's where it gets interesting. Even the core CPI, which strips out volatile stuff like food and energy, dropped by 0.1%. That's the first decline since 2021. Part of this is thanks to crazy price wars in the electric vehicle market. Companies are slashing prices to compete, and it's dragging the numbers down. It's not just consumers feeling the pinch. Producers are struggling too. The Producer Price Index, or PPI, fell by 2.2% in February 2025. That's a signal that manufacturers are dealing with lower demand and higher costs, making it tough to turn a profit. So what's China doing about it? The government's not sitting still. For 2025, they've set a GDP growth target of around 5%, ambitious but doable, and lowered their inflation goal to just 2%, the lowest in over 20 years. To get people spending, they've rolled out a massive RMB 300 billion, about $42 billion USD, subsidy program for appliance purchases. Think discounts on fridges, TVs, and washing machines. But economists say that's not enough. They're calling for bigger fixes, like improving the social safety net so people feel secure spending, or tweaking the tax system to put more cash in households' pockets. Without these deeper reforms, deflation could stick around longer than anyone wants. Falling prices might sound good on paper, but if consumers keep holding off and businesses struggle, it could slow down China's recovery from years of economic challenges, like the post-COVID slump or the real estate mess. On the flip side, China's got a track record of bold moves. If they nail these reforms and boost demand, they could turn things around. But it's a race against time, and the world's watching. That's it for today's deep dive into China's deflation drama. If you found this helpful, give it a thumbs up, share it with your friends, and hit that subscribe button for more updates. See you in the next one.